Hello, investors and market enthusiasts. Welcome to our channel. Today we're diving into a question that has kept many people awake at night and dominated financial headlines. Is the stock market in a bubble that's about to burst? It's a complex question, full of nuances, and the answer isn't a simple yes or no. But the concern is real, and it's crucial for every investor, from beginner to expert, to understand the signs and implications of a potential stock market bubble. In recent weeks, we've seen records being broken, valuations reaching historical highs, and an optimism that, for some, borders on euphoria. But at the same time, whispers and warnings about an imminent financial crisis or a market crash are spreading through Wall Street corridors and social media. Are we on the verge of a major market correction, or are these just the usual fears that arise after long periods of growth? In this first part, we'll contextualize this concern. What exactly is a stock market bubble? In simple terms, it's when asset prices rise rapidly and unsustainably, detaching from their intrinsic and fundamental values. It's driven more by speculation and the psychology of getting in before it's too late than by solid economic data. Historically, we've had the dot-com bubble, the housing crisis of 2008, and even the tulip mania. All of them had warning signs that, in retrospect, were quite clear. Are we seeing these signs now? We'll analyze some of the main indicators raising red flags: stock valuations at stratospheric multiples, rampant enthusiasm in certain sectors, especially tech and AI, increased participation from retail investors with leverage, and the FOMO, fear of missing out behavior that leads many to invest without proper research. It's important to note that a bubble is only clearly identified after it bursts. Our goal here is to understand the risks present in the current stock market and how that might affect your personal finance. Stay with us, because next, we'll delve into the arguments for and against the existence of a bubble, and more importantly, how you can protect your capital. Now that we understand what a stock market bubble is, let's examine both sides of the coin. There are economists and market analysts who vehemently argue that we are in bubble territory, while others contend that the current growth is justified by strong fundamentals. It's crucial to hear both sides to form your own informed opinion about the health of the stock market. One of the most cited points is stock valuation. The PE price-to-earnings ratios of many companies, especially in tech, are at historically high levels. This means investors are paying a very large premium for future earnings, which could indicate inflated expectations. Another sign is the excess liquidity in the system, a result of years of expansionary monetary policies by central banks. This cheap money had to go somewhere, and much of it flowed into the stock market, inflating prices. There's also the herd mentality and speculative frenzy in certain meme stocks or trendy sectors, where fundamental logic seems to have been set aside in favor of pure enthusiasm. The participation of retail investors, many new to the market and inexperienced with volatility, also raises concerns. History shows us that when everyone is in the market, especially when a lot of leverage is used, the risk increases exponentially. Rising inflation and potential central bank reactions, like increasing interest rates, could be the trigger for this supposed bubble. On the other hand, many analysts argue that current growth is justified. They point to corporate earnings growth, driven by technological innovation like artificial intelligence, which is genuinely creating value and increasing productivity. Companies like Nvidia and Microsoft, for example, are delivering robust results that partially justify their high valuations. Furthermore, interest rates, despite having risen, are still at levels that historically favor stock investments compared to fixed income assets. The digitalization of the economy, accelerated by the pandemic, has created new markets and business models that didn't exist before, ushering in a new paradigm of growth. There's also the argument that diversification and market globalization make a single, isolated bubble harder to form, and if it does, its burst might be more contained. Institutional investor money, which is generally more patient and long-term, remains anchored in the market. The truth is, the market is complex and multifaceted, and not all indicators point in the same direction. Understanding these arguments is the first step in preparing for any scenario in the stock market. Regardless of whether you believe that if stock market is in a bubble or not, financial prudence is always a good idea. Protecting your personal finances and your investment capital should be a constant priority. After all, volatility is part of the game, and being prepared for a market crash or a market correction is essential for your peace of mind and the health of your investment portfolio. The first and most important strategy is diversification. Don't put all your eggs in one basket. This means not only diversifying across different stocks but also across different asset classes. Consider allocating part of your capital to real estate, fixed income securities, especially short-term government bonds that can offer protection against inflation and higher interest rates. Commodities like gold, considered a safe haven in times of uncertainty, and even a small percentage in cryptocurrencies if you understand the risks in your profile allows. Geographic diversification is also crucial. Don't concentrate all your investments in a single country or market. Secondly, the importance of a robust emergency fund cannot be overstated. Having 6 to 12 months of your essential expenses saved in an easily accessible, low-risk location like a high-yield savings account or money market fund is fundamental. In case of a financial crisis or job loss, this reserve prevents you from having to sell your investments at the worst time when prices are low. Furthermore, review your stock valuations. If you invest in individual stocks, reevaluate the companies in your portfolio. Do they still have strong fundamentals? Does the current price justify their future earning potential? Avoid companies with excessively stretched valuations and inconsistent profits. Focus on quality companies with strong balance sheets and a history of resilience. Also, consider strategies like dollar-cost averaging (DCA), which involves investing fixed amounts regularly, regardless of market fluctuations. This helps smooth out the impact of volatility and prevents you from trying to time the bottom or the top of the market. Finally, maintain a long-term perspective. The stock market, historically, has always recovered from downturns and crises. Those who panic and sell everything at the bottom are the ones who lose the most. The goal is to build wealth over time, not to speculate on short-term cycles. Be prepared, but don't panic. Even in a scenario of concern about a potential stock market bubble, it's vital to remember that every crisis brings opportunities. For the patient and well-informed investor, a market correction or a market crash can be a golden opportunity to buy quality assets at discounted prices, paving the way for significant long-term growth. History shows us that the greatest fortunes are often built during periods of difficulty, when the majority is in panic. The key lies in your financial mindset. Avoid the noise and sensationalism from the media. Focus on your long-term goals and your investment plan. Don't be swayed by emotions, neither by excessive euphoria when the market is up, nor by despair when it falls. Discipline is your best friend. Revisit your goals, adjust your asset allocation if your life situation changes, but resist the temptation to make impulsive decisions based on fear or greed. Continuous financial education is your greatest weapon. Keep learning about personal finance, about investments, about the global economy, and about the companies where you put your money. The more you know, the less likely you are to fall into traps or make impulsive decisions. Use reliable resources, follow serious analysts, and understand that learning is a never-ending journey. The best protection against any financial crisis is knowledge. To conclude, the question is: the stock market in a bubble doesn't have an easy or definitive answer today. There are valid arguments on both sides. However, the real question for you as an investor is: are you prepared for any scenario? Are your investments diversified? Is your emergency fund intact? Is your mindset focused on the long term? If the answer is yes, you'll be in a much stronger position to navigate the uncertainties of the stock market. Whether it's a bubble about to burst or just a phase of accelerated growth, remember, the ultimate goal is financial independence. Stay calm, stay informed, and keep investing intelligently. If this video was helpful, please like, share it with anyone who needs to hear this message, and subscribe to our channel for more content that will help you on your path to Financial Freedom Hub. Thanks for watching, and we'll see you in the next video.